So given the federal rate hike and the eventual graduation of the QE program in Europe, I think we really have to make sure that we have a very diversified funding strategy. So don't rely on one or two markets. So in addition to the traditional euro-dollar market, of course, we try to reach as many currencies as possible. We try to use different structures to attract different investors. So last year, which we did a historic high number of transactions for a $14 billion program. We issued over 360 bonds. That really demonstrates the level of diversification we have been trying to achieve. Those cover about 27 different currencies in terms of format, in addition to global benchmark. We have done quite a number of floating rate notes to address the anticipation of the investors with the rate hike. And also we have done quite a number of callables, which now with a hike, extended our duration very much. We continue to focus on the Euro-Dashi market. But we also expanded more in the Aussie and New Zealand market. For example, we issued the first social bond in Aussie dollar and our first green bond in New Zealand. And we are starting to issue retail bonds in the Italian market. We also continue to diversify our currencies, beyond the traditional Mexican peso, Turkish lira, so on and so forth. So really, the key word is diversification, so that we make sure that we have access to funding for one of the most, reputable AAA issuer names. So this is very exciting. During the spring meetings, our shareholders endorsed a package of capital increase, both for IBRD and for IFC. So for IFC, it's about a 5.5 billion capital increase. Of course, now it is going through a rectification process by national parliaments. So once we receive the capital increase, I think IFC's plan is that this would give us the ability to significantly ramp up our investment program. For example, right now, our long-term annual investment in emerging market is about 11–12 billion. With the capital increase, we plan to double it in about 10 years' time. So that also means a corresponding increase in our funding program. So we are very, very excited. So IFC's investment priorities are a product with the World Bank and with governments, where for each country we do a proper country systemic diagnostics to really figure out what are the gaps the country needs in terms of stimulating economic growth and creating jobs. But generally speaking, in many of our client countries, basic infrastructure, road, transport, electricity, still there is huge gap. Take electricity, for example. One big priority is renewable energy. So last year we introduced a global innovation called the scaling solar solutions that standardize the approaches of PPP so that we can deploy renewable energy solutions using private sector sponsors much more quickly. So another priority obviously is working with local financial institutions, because we want to encourage them to reach SMEs and women entrepreneurs to really step up their funding of support. Education is important, agribusiness is important. So depending on the country's needs, we will work with them to address their priorities. Indeed, I think we have been really focused on developing capital market in local currency, and this became even more evident after the commodity super cycle where a lot of commodity prices collapsed, causing many African currencies depreciate dramatically. Therefore, many of our clients are switching their appetite from borrowing dollars from us to borrowing local currency. So about 7 years ago, we created a Pan-Africa domestic MTN program through which we'd like to systemically become a local currency bond issuer. Involved in that is not only putting our name there, but helping the government to make sure there are a proper regulatory framework, there are market plumbings that are ready for a AAA issuer. So over the past couple of years, I think we have made tremendous progress. We have now issued in the past couple of years in Nigeria Naira, in Botswana Pula, in Zambia Kwacha, in Namibia, and in Rwanda franc. And so we are working in quite a number of different jurisdictions. What is different now is that instead of issuing a one-off bond, we'd like to create a shelf registration, just like in our Euro-dollar program, global MTN program, so that we get one-time approval and we can tap the bond market as and when we need funding. So we anticipate that in the next 5 years, we're going to ramp up our local currency lending in sub-Saharan Africa significantly. The biggest risk for our clients are reduced appetite of investing in emerging markets, because when interest rates become higher in OECD countries, especially in US dollar and in euro, I think a lot of FDIs will probably switch back into, higher coupon US Treasury and other assets. So this actually means we, the community of multilateral development banks and DFIs, have to step up. How do we then not only invest our own balance sheet, but use our balance sheet as a risk mitigant to encourage institutional investors to come with us to emerging markets? So there, I'm very pleased to say that we have made some breakthrough. We have raised $7 billion from both government and private sector institutional investor money to come along with us in investing in project financing in emerging markets. This is a platform called MCPP, Managed Core Investment Portfolio Program. Essentially, those institutional investors would rely on our global best standard due diligence and deal origination, and by formula automatically participate in our future project origination. So this is our way of hopefully attracting additional OECD liquidity into emerging markets.